Good morning, everyone. Welcome back to Your Money Matters. I'm Angela Giroux, publisher of the Bauman Letter. And with me today are Ted Bauman, editor of the Bauman Letter, and Clint Lee, our research analyst. As a reminder, if you are interested in finding out about the Bauman Letter and all of our winning recommendations in our model portfolio, there is a link below. I invite you to click that link and join us risk-free. And then as a quick reminder, we're recording this on a Friday, and we're still kind of going through this election chaos, I guess you could call it. We don't have an answer yet. It's looking more and more likely that it will be Joe Biden as the winner, but a lot can still change. And we all have some election fatigue. I know that I sure do. So the Friday video, Clint, Ted, you guys talked about the plan A of the blue wave that everyone sort of anticipated on Wall Street that would happen, which would be more stimulus, a unified government. But now it's looking like plan B, where we have a divided government, we have gridlock, things aren't really going to get done. So this changes the game a little bit. Clint, let me ask you, what is the best play for short-term gains given this environment that we're looking toward?
I know everyone's been absolutely fixated on stocks here the last couple of days. And I mean, you've seen the stock market just absolutely rip higher as it became clear that gridlock was becoming the more likely scenario for the election outcome versus the blue wave that you mentioned. But with as much upside as we've seen in the stock market the last couple of days, my attention now has actually been turning to the U.S. dollar. And that's because we're sitting right on some important, some very key levels that if those start to give way, that's going to really start to highlight some opportunities in international markets. So just to show you what I mean, here's just a shorter term chart of the US dollar, just going back about 5 years or so. And you can see we haven't really broken down below sort of that key 90 to 92 level, but that's really what I've got my eye on right now. And that could, we've seen some weakness now in these days following the election, and that could be for a number of reasons, just because maybe the lack of a big stimulus package and that impact on growth is going away, or maybe it's because the Fed is going to have to do more heavy lifting to stimulate the economy. So does that keep rates low for longer? For whatever reason, I'm watching for dollar weakness right here. And the implication that has for international, I'll show you a chart from the prior big up cycle that we saw in emerging markets to highlight this point. So take a look at this chart. This shows the US dollar is sort of this dashed blue line against the emerging markets, the price index, which is the green line on here. And this goes from about the end of 2000 through the end of 2007. And you can see sort of this collapse that we had in the blue line over that time. And how it correlated inversely with that surge higher in emerging market stocks. And the main reason why that happens is because when you buy this emerging market ETF, you're holding underlying stocks on foreign exchanges. And the way it works is if the dollar strengthens, that actually eats into your returns, that negatively impacts your returns. But if the dollar is weakening against those other emerging market currencies, that helps add to your returns. And there's other indirect benefits that emerging markets can see from that as well. But the impact is clear that has, as you can see in this chart, on prices for those international markets when the dollar starts to weaken. And so that's why I'm watching those price levels very closely.
Okay, and that's up to 2007. So Ted, let's talk more recently of what we've been seeing.
Well, yes, I mean, this, I want to show you a chart that shows recent action in the dollar. This is over a 3-month period. The dollar has been up and down. Right now, I think that in the far right-hand side of the chart, you can see those are pretty precipitous drops. I mean, we've seen drops in the last 3 trading sessions, pretty significant. It's not just kind of normal up and down. Now, there are really 2 reasons, I think, why the dollar could be moving the way it is. As Clint has mentioned, the fact that the United States is not going to be probably pursuing any fiscal stimulus, which, interestingly, the Federal Reserve yesterday called for yet again, saying, please help us, we can't do this on our own. The fact that that's not going to happen now means that real economy growth in the United States is probably not going to make much headway in the near future. I spoke on Friday about lots of headwinds, increased tax rates that are coming in thanks to the 2017 tax bill, furloughing and turning into unemployment. There's going to be a lot of headwinds in the real economy. So people are not wanting at this point to hold on to the dollar if they think the economy is going to weaken. On the other hand, we're seeing a lot of rebound in other parts of the world. The Chinese economy has rebounded strongly, so a lot of people are pulling money away from the U.S. and going over there because that's where the growth is happening. And that's just the reality of the global market, and we're starting to see this. So I think the election was a trigger for something that really depended on, again, that blue wave, that the strength of the underlying real economy, the small caps, all those really depends on federal intervention, which is now not likely to happen in the near future. So here's a second chart that shows the 6 months performance of one of our favorite ETFs, which is the emerging markets EEM. And as you can see, it has consistently outperformed the S&P 500 over the course of the last 6 months. It has picked up a lot of steam. So has the S&P 500, but it is significantly above that level. And we see that going forward. That's really my key prediction here, is that I think we're going to continue to see a big rotation into these emerging market companies and countries. Now, I want to show you one final chart that breaks out a couple of specific countries that I like personally as potential investment opportunities. Again, you see the S&P 500 in red, you see EEM in green, a little bit of a pullback in the last day or two, but then you see the Brazil and Indonesia ETFs. You can see the tickers up at the top, EWZ and IDX. And both of these are outperforming the US stock market in the last month. This is a 4-weekly chart. Now, why would that be the case? Well, Brazil, is got just all kinds of things going on. I know it's also got a big problem with COVID. It's got a lot of political issues that are very similar to the US, but it also is on the verge of a big transition from an older financial system to a modern financial system like China. And the opportunities there are endless. I mean, there are just lots of companies springing up that are making huge gains very quickly, and their stock prices are rising rapidly. We've been very interested in those in the Bauman letter, for example, and it's indicated in their national ETF. The other one is Indonesia. Indonesia is picking up a lot of business leaving China. They are well set up to be a manufacturing hub like Malaysia next door. They have a good, solid, educated workforce. They have good engineering. They have good policy frameworks for manufacturing. And so I think that is being reflected in their stock market. Now, remember, the final thing is that whenever we show ETFs, you don't have to just buy the ETF, go and look at their holdings. And there's some really good companies, particularly in EEM, that you'll see there's overlap with some of them, but these are companies, we hold some of them as individuals. I'm not going to say which, but our bets have paid off really, really well on these foreign companies, and they will continue to do so, particularly as the dollar weakens, because it increases the dollar value of their earnings relative to the US dollar. And that's always good for us.
Right, so any one of these ETFs that you mentioned might be a way to play this for the shorter term gains that you're talking about.
Yeah, I think if you want to just play the broad thing, then yes, I think EEM is the way to go. I think, like I said, Indonesia has shown some really strong gains in the last month. So again, I think this is not just about the reversion or the cycling of investment towards the emerging markets, but it's also about that country's specific opportunities. Clint, I don't know about what you think.
Yeah, well, you've highlighted the short-term opportunities and the short-term decline that we've seen in the dollar here. But the other thing I would highlight from that end is that there's long-term opportunities in these international markets as well. Because when you start to take a longer-term investment horizon, a longer-term view, valuations are so important to the ultimate returns that you realize. And we've pointed out plenty of times how expensive U.S. stocks are right now, but how cheap other parts of the world are. And I'll show a chart here. We've shown similar figures here before with these cyclically adjusted price earnings ratios, which just takes earnings and smooths them over a business cycle. But right-hand side of the chart, you can see the U.S. on that measure is trading at right around 30 times on that multiple. But then you look at Korea, Indonesia at 13.3 times, Brazil at 15.5 times, emerging markets as a whole right around that 15.5 level there as well. So just highlighting the runway that those valuations have to grow when you start to take that longer term viewpoint there as well.
Right, and one more thing. That's a point we've made a couple of times, and it's not a small point. It just looks like numbers, but remember, what you're talking about is how much you need to pay to get $1 of earnings from a company, and particularly if the dollar weakens, it increases the dollar value of the earnings of these, or rather, the foreign currency value of these earnings increase, and you get more in dollar terms, and that's bullish for those companies. So the ideal strategy is to buy foreign when the dollar is strong, and then rake in the profits when the dollar is weakening. A little late for that, but there's still plenty of room for the dollar to fall, and this could still be a good option for a lot of people.
All right, well, thank you. I think that about wraps it up for us today. Hopefully when we reconvene, we will have some definitive answers and we can take a look ahead with a more clear vision of what lay ahead. And that being said, again, we invite you to join us at the Bauman Letter, so please do click below. In the meantime, thank you for joining us.